Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Amazon stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Amazon is a technology company based in Seattle, Washington. It focuses on e-commerce, cloud computing, digital streaming, and artificial intelligence. It is considered one of the big 5 IT companies in the United States, along with Google, Apple, Microsoft, and Facebook. The company has been referred to as one of the most influential economic and cultural forces in the world. It's also considered the world's most valuable brand. It was founded by Jeff Bezos in 1994. The company started as an online marketplace for books. In 2015, Amazon surpassed Walmart as the largest retailer in the US. Let's get started with the model. This is a large cap company, 1.4 trillion market cap. They're trading at $3,200 a share, and they have 501 million shares outstanding. Let's look at the financials. The way you value a company is you forecast future free cash flows, then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow each year. Net income is the profit and loss on the income statement. That's revenue minus expenses. And they also have positive and growing net income each year. Revenue is the sales for the company, and it was $177 billion in 2017, then grew to $321 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales, and it's amazing how much their sales have grown, because they almost doubled their sales from 2017 to 2020. Doubling your sales from 100,000 to 200,000 is not that big of a deal, but from these large numbers to double them, it's pretty amazing. Below the revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is the gross profit, which is the difference between those two numbers. They also have operating expenses. So they have a good amount of operating income each year, $17 billion in the trailing 12 months. They also have to pay interest on their debt. They have some other income and expenses. This is usually from investments or impairments. And the bottom line of their income statement is their net income. And it grew quite a bit from $3 billion to $13 billion. This is their statement of cash flows. The top line is operating cash flow. That's how much money the company generates from its operational business. This line is capital expenditures, the investments in property, plant, and equipment. And to calculate free cash flow, it's operating cash flow minus CapEx. That gives you free cash flow. And their free cash flow grew from $6.5 billion to $27 billion, which is a ton of free cash flow to work with. And you can see they issued $16 billion of debt in 2017, then $770 million, $2.3 billion, and $15 billion. But they repaid $6.4 billion of debt, $8.5 billion, $12 billion, and $15 billion. So they probably paid as much debt back as they issued, so they haven't really added much more debt. Whenever you look at a business, you should look at their operating cash flow, because that's really the lifeblood of any business, how much money they generate through their operational business. They generated $51 billion, and the way you calculate that is you take the net income, which was $13 billion, then you add back the non-cash items from the income statement. They had $23 billion of depreciation, then another non-cash expense is $1 billion of deferred taxes, $8 billion of stock-based compensation. These are all amounts that have to be added back on operating cash flow. So the company actually generated $51 billion of cash through its operational business. That's a ton of cash. And their cash flow tripled from 2017. So even though they were huge in 2017, they managed to triple their business. Let's look at a capital structure. They have $62 billion of equity, $63 billion of debt. But their net debt is $8.2 billion. Net debt is total debt minus cash. So they could almost pay off their entire debt with the cash on their balance sheet. The interest they pay on their debt is 2.6%. Cost of debt is 2.1%. And their capital structure is 50% debt, 50% equity. Cost of equity is 11.5%, and their beta is 1.2, so the stock moves a little more than the market. It's not too volatile. And their WACC is 6.8%, and that's a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows We also estimate a terminal value, which is all cash flows past year 4, that's 1.6 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 trillion. We divide that by 501 million shares. And we get a calculated stock price of $2,900. They're trading at $3,200, so they're trading at a 13% premium. It's a sell according to the model. Simply Wall Street values the company at $3,700, so they're saying it's a buy. I used an aggressive approach when valuing this company. I expected their free cash flows to grow at a fast pace, just like it's been growing the past few years. I still came up with a valuation lower than what they're trading at. I'm not implying the company's not worth $3,200. It's worth whatever you feel it's worth. The investing community obviously feels it's worth $3,200. And if the company keeps growing at this pace, the sky's the limit. I wouldn't be surprised if their market cap was $5 trillion in 10 years. This is where the stock has been trading at the past 5 years. So you can see it's only been increasing. It really hasn't ever dropped, maybe for a few months, but pretty much it's on an incline. If you invested $10,000 in this company 10 years ago, you'd have $182,000 today. The stock has increased 81% in the past 52 weeks. That's much better than S&P, which increased 15% in the same time frame. The 52-week low was 1,600. The 52-week high was 3,550. And the stock is trading above its 50-day moving average and above its 200-day moving average. Not many stocks are trading above their 50-day and 200-day. That means the stock is in a major uptrend. And when the 50-day moving average moves above the 200-day moving average, that's considered a golden cross. That's a really bullish sign. The average trading volume is about 5 million shares. It's only 3.5 million in the past 10 days. That's because the stock price is so high, so there's not many shares traded. If the share price was under $100, the volume would go way up. And of the 501 million shares outstanding, 428 million are on float. And about 59% of the shares are held by institutions. And less than 1% of the shares are shorted. That's a really low short percentage. Jeff Bezos founded the company in 1994. He then went public in 1997. The company began selling music and videos in 1998. The following year, the company sold video games, electronics, home improvement items, software, games, and toys. In 2002, they started Amazon Web Services. In 2006, it opened fulfillment centers so it could manage the inventory for individuals and small companies. And in 2017, it acquired Whole Foods. The company has many partnerships. In 2000, Toys R Us entered into a 10-year agreement with Amazon. In 2001, Amazon partnered with Borders Group. Then in 2011, they partnered with DC Comics. In 2013, they partnered with the United States Postal Service. And in 2017, they partnered with Nike. In 2018, they partnered with Apple. Over 130 million people visit the US Amazon website each month. Amazon is the third most popular website in the US. And 14th most popular in the world. The company has personalized websites in many countries: Brazil, Canada, Mexico, Japan, Germany, Sweden, Australia, and many more. The company's largest shareholders are Jeff Bezos, 10.5%, Vanguard, 6.5%, BlackRock, 5.5%, Mackenzie Bezos, 4%, State Street, T. Rowe Price, and FMR. Jeff Bezos is the world's richest person, and Mackenzie Bezos, his ex-wife, is the world's richest woman. And some people criticize people like Jeff Bezos for having so much money, but he was able to build a company and provide over 1.1 million jobs. I think he deserves every penny, because if you can build a business and take that risk and provide people a salary and benefits so they can support their family, you're doing a great thing. Let's look at the financial ratios. The average PE in the market's 12, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 123, so they're doing much worse than the median and average. Price to sales is stock price over sales per share. They're at 5.0. So that means investors are paying $5 for $1 revenue. That's between the median and average. Price to book is stock price over book value per share. They're at 26, so they're much higher than the median and average. The way you calculate book value per share is equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $62 billion. Their tangible equity is $43 billion, so they have about $19 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 10.2, so they can easily cover their interest payments. ROE is net income over equity. They're at 21%, much higher than the median and average. Current ratio is current assets over current liabilities. They're at 1.1, so they can cover their current liabilities. Their current assets are $55 billion of cash, $21 billion of receivables, and $20 billion of inventory. So their free cash flow in the trailing 12 months was $27 billion, and they have $8.5 billion of working capital. So the company has plenty of cash to work with. No problems here. The best way to look at ratios to compare them to similar companies, I've done videos on Momo, JD, Alibaba, Chewy, eBay, Etsy, and Jumia, all in the same industry as Amazon. And if Amazon has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE, they are better in price to sales, they're much worse in price to book. Current ratio, they're above 1, but they're worse than the average. They're pretty close to average in ROE. They're a little higher in debt. In terms of market cap, they're by far the biggest. They're one of the biggest companies in the world, and they don't pay a dividend. So to summarize, I do have them trading at a 13% premium, but I've said this before, I think Amazon is always a buy. They're such a great company. They're head and shoulders above the rest, and their financials look amazing. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.